right, so I'm gonna start in with some new stuff, but it's kind of it's not entirely new. It's going to be things that we've seen in terms of options. We're going to think about options as it relates to firm valuation, and options as it relates to the relative payoffs to bondholders and stockholders. What we're going to do today is we're going to think. I'm going to set this up. I think we're not going to finish all this lesson today, but I want to set it up by just thinking about the payoffs to stockholders and bondholders in the event of bankruptcy. So we've talked about the cash flow, like the pie model of the firm. There's a pie which represents all of the the obligations of the firm, or it represents the cash flows that come into the firm, and then also where those cash flows where they end up. So we have stockholders, which get some portion. We have bondholders, which get some other portion. And it's always these are not equal footing. It's a tiered structure. So the bondholders always get paid before the stockholders do, provided that the firm has enough cash to pay them. So that it's a little bit tricky. There's the loan contract which obligates the firm to pay the bondholders their interest and principal, provided that the firm has the cash. Now there's kind of an ability for firms to insulate themselves a little bit from that. There's bankruptcy law, which gives firms what's called limited liability treatment, where in the event that they fall on really hard times, they're able to declare bankruptcy, and they can go into court and sort of restructure their loan contracts with the bondholders according to sort of the cash and assets that they have available, and they'll the lawyers of the firm will meet with the lawyers of the bondholders to renegotiate that. And the bottom line there is that it's possible for the bondholders eventually not to get paid back everything that they've invested in the firm. And as we've seen, there's actually bondholders of course are aware of that, and so they in some sense charge a premium on their debt, knowing that it's possible that the firm may declare bankruptcy. So we've thought about the risk-free rate as being something about the treasury bonds, U.S. treasury bonds, which have something close to a 1% yield or something even below that in some cases. Those are relatively safe assets. The U.S. government has never defaulted on its debt before, and in the event that it needs to pay back its debt, it has the ability to raise taxes to do so, which firms don't have. So there's always, at least historically, there's been pretty much a guarantee that those holders of U.S. Treasuries will get paid back, and so we have a risk-free rate of something around, like 1%. There's also we've talked about the cost of debt. That's like this RB number that we've included in the WACC equation. That can be something higher than 1%. Usually that's something closer to 5%, 4%, 6%. And this extra cost of debt, this rate is charged above and beyond just the risk-free rate, essentially because there's some risk that when you as a bondholder lend a firm money, that you're not going to get paid in full. And so that's kind of what we're going to talk a little bit about that today. I'm going to present a stylized example of that, and then think about how that affects the relative payoffs to the stockholders and bondholders, and how that in turn affects the desire for risk. Actually, and we've seen this concept before. We saw it in the options problems in lesson 4, where there's some chance that oil prices could go up or down. You don't have to drill if they go down, but you do have the option to drill if they go up, in which case you get to capture the upside, but not the downside. we saw this a little bit too with the fact of leverage increasing the expected returns. We saw that with the blackjack table example, how taking some borrowed money to the table and paying interest on that can increase your expected returns. I'd encourage you to go back and look at the notes to remind yourself of why that's true. We look at that with that blackjack example, as well as with a simple example with the firm, the way that the earnings per share for the firm can increase in expected value after debt is taken on. That was stuff we covered at the beginning of lesson 9 on the Modigliani and Miller stuff. So again, I'd encourage you to go back, review that. But those ideas are going to come back in full force now as we're talking about firms as a whole, and specifically the different incentives of stockholders and bondholders, and the different desires for risk taking that these stockholders and bondholders have. They're not going to think about risk the same way because of the structure of the payments, how cash flows get paid out. They get paid out first to bondholders, provided there's enough cash available, and then the stockholders get the residual. So we'll see. I have an example here of how this payment structure affects risk-taking incentives of the firm. If you're curious to go back and look at Ross chapter 17, I believe this kind of example is there in the book that you can follow along with and read. But I want to present it here because it sets us up nicely for then thinking about these options concepts as applied to firms being able to merge together. So here's the setting. I have a firm. One firm is, I'm going to call it firm A. It's got some debt obligations, so it's borrowed some money. It's got $49 worth of debt obligations. So this is those fixed debt payments that they have to pay back before the stockholders are able to collect dividends or benefit at all in any other way from the cash flows. So we start with two economic scenarios. One, this green column, the column with the green numbers, is a boom scenario. That's when the firm is making a killing. The red numbers are recession, and that's going to reduce cash flows overall for the firm. These $49 worth of debt payments are required to be paid back regardless of the state of the economy. This could be some combination of interest and principal. It doesn't, we've sort of been looking at this being specifically interest, but in general, it's just debt service. So this could be interest or principal. I'm saying that's $49. So the firm has some cash flows. This is just a summary number. There's, we went through financial statements in lesson 2. So there's a lot of line items that go into this. There's depreciation, there's administrative costs, there's revenues, there's taxes. Let's just say that the cash that's available after after all their suppliers have been paid and after their taxes have been paid, let's say that $100 is what's available to distribute either to stockholders or bondholders. So in the case of a boom, in this column with the green numbers, cash flow is $100, interest is $49, and stockholders, therefore, after bondholders are paid, they take home $51. And in this case, we have cash flows are enough to cover bondholders. So bondholders do get paid in full. The answer to that question at the bottom row is yes. Cash flows cover the interest payments. Okay. For firm A, a recession only gives you $50 of cash. 49 goes to pay your bondholders. Those have to be paid first. What's left over after you do that is just $1 available for stockholders. So stockholders get much less. But it's the case even in a recession under this amount of debt, it's the case that bondholders still do get paid in full. Okay, so that's one example. Firm A, where its debt obligations are only $49. Bondholders get paid in full either way. Now let's just take this to another example. Firm B, let's say Firm B has exactly the same underlying kinds of activities. The same things are going to produce cash flows of 100 in a boom and only 50 in a recession. The only difference here is that these debt obligations for Firm B are $60. Okay, so that cash flow, that top row, either the $50 or $100, that's what's available to get distributed to either the bondholders or the stockholders of the firm. The interest gets paid first. So this $100 of cash flow, some of that, $60 of that is used to pay the bondholders. What's left over to stockholders is just the $40. And then this bottom row, the question, do bondholders get paid in full? The answer is yes. Cash flows are enough in this case to pay back the total amounts of interest and principal that are owed to bondholders. Now, in a recession, this is actually the same cash flow that Firm A had. Firm A had the same, Firm A, this is back at Firm A. Firm A had $50 in a recession as well, but debt obligations were only $49. In the case of Firm B, cash flows in a recession are still $50, but debt obligations are $60. This firm is more levered. Firm B is more levered than Firm A. Okay, and so the lawyers from the bondholders and the firm get together. They say, the firm's lawyers say, look, we've fallen on hard times. We've made an honest effort to get enough cash flow to pay you back, but we just weren't able to do it. And the bondholders, because of the limited liability property of corporations, they're having to eat some of that losses, provided that they can't prove that there was malfeasance or really bad negligence on the part of the firm. That's what the lawyers in part will discuss, is whether or not the firm's behavior was shady or dishonest, whether they, through some gross mismanagement, they weren't able to generate enough cash. That's what the lawyers themselves will discuss. But provided there wasn't any ill intent, any dishonesty, or any malfeasance, only $50 will get sent to the bondholders. So then in that case, it's the $60 is owed to the bondholders, but there's only 50 available under the honest efforts of the firm to make up its obligations. So this $50 of cash flow up here gets completely distributed just to the bondholders, and the stockholders in that case are left with zero, which is less than what the stockholders were left with in the previous example. In Firm A, with only $49 of debt, stockholders walked away with $1. In the case of a $60 obligated debt payments, they walk away with nothing. But critically, bondholders are not paid in full in this case. In fact, they're down. You can think of them as being down $10 relative to what they were promised. So they're sort of out of luck, and they lose $10. And again, that was sort of built into the cost of debt. I mean, the debt holders, or the bondholders weren't going into that contract completely unaware of what could happen if the firm declared bankruptcy. So that premium that was charged, between the cost of borrowing RB and the risk-free rate, that premium in part reflected the risk that the firm would end up going bankrupt and not be able to meet its full obligations. Okay, but the limited liability structure of the firm insulates the firm from being obligated to pay back any more than what it has, provided again that it's been honest in its dealings. So that's the scenario under under the leveraged firm. Firm B is kind of a symbol of a leveraged firm whose cash flows under recession conditions are not enough to pay back its bondholders in full, and so bondholders end up losing in that case. So that's just a numerical example to show how this cash gets distributed to bondholders and stockholders. I want to give another numerical example to show the implications that this has for risk taking. So under this structure where bondholders get paid back first, but they don't get paid in some scenarios when the firm's cash flows are not enough to make up the interest payments and the debt payments. That payment structure affects the risk preferences of these different parties. So we want to think about these risk-taking implications for the stockholders versus bondholders. Bondholders and stockholders are going to look at these two projects much differently. We're going to think about just a simple case. There's two different possible projects that the firm could undertake. One of them is just going to be a low risk project. There's still some risk, but it's relatively low. Another is a high risk project. And these projects are going to generate different cash flows under different economic conditions. So the low risk project has a spread of 100. So the cash flows in the case of recession are 100. In the case of a boom, those cash flows are 200. The spread here is 100. The spread in the case of the high risk project, it's almost like I've added 50 on each side, except I've actually, the upside in the boom is only going to be 240. And I'll explain kind of why I chose that number in a second. But in this case, there's sort of the possibility of losing $50 more in terms of a recession for the high risk project relative to the low risk project. But you're able to gain more in the boom under the high risk project, but it's only $40 more. It doesn't actually make up for the possible losses that could occur. And we'll calculate the expected values of these in a second. I'm just going to assume that these probabilities are 50-50. These are each equally likely. So let's consider the payoffs here to stockholders and bondholders under these two projects that have different levels of risk. I'm going to say that bondholders in this case are going to be owed $100. So that's the debt obligation. That's like the $60 payments for firm B that we saw before, or the $49 payments for firm A that we saw before. In this case, for this next example, I'm saying that the bondholders are owed $100. So in the event of this slide is going to show the low risk project, the different payoffs under the low risk project. So under a recession, cash flows are only 100. Under a boom, cash flows are 200. That's what we had on the previous slide. That's these the numbers in the top row. Those are the two possible outcomes for the low risk project. And then this cash is going to be distributed in some way between stockholders and bondholders. Bondholders get paid first. Bondholders always get paid first. So the $100 that the firm has in the recession is paid to bondholders, and stockholders end up with nothing in that cash flow scenario. In the case of a boom for this low risk project, the cash flows are 200, and bondholders again, they get their 100. So because there's enough cash to cover that debt service, but they don't get more than 100. When there's a boom, the bondholders don't get a premium for their lending to the firm. Their premium is sort of, or their amount that they can receive is capped at 100. So that just has to do with the tiered structure of the payments and the fact that the stockholders are the residual claimants on the firm's cash flows. So this 200 gets distributed equally in this case, between stockholders and bondholders. Stockholders get 100, bondholders also get what they've been promised in the $100. That's for the low risk project. Now we can consider the high risk project. Remember, this has a higher spread. There's a larger gap between the cash flows in a recession versus those in a boom. Again, we have $100 being owed to bondholders in their loan contract. But again, as long as there hasn't been foul play on the part of the firm or dishonesty on the part of the firm, then the cash flows that they generate will be paid out, and there won't be any way for the bondholders to get any more than that. So $50 in the recession is what the firm gets under this high risk project. That all goes to bondholders, and nothing goes to stockholders in that case. But again, in the case of a boom, we have larger cash flows available. Bondholders get their 100, and then stockholders get their residual amount, which is in this case 140. It's just the cash flow minus what was owed to the bondholders. Okay, that's the high risk project. So bondholders get shortchanged a little bit under this high risk project, whereas in the low risk project they get paid in full regardless of what scenario actually happens. And then stockholders, they have a kind of a lower bound on their returns set at 0, where they get nothing in the case of a recession, but they get 140 in the case of a boom. So this is going to be, I'm going to use this example just to show how this payment structure is critical for understanding a little bit of the incentives of stockholders versus bondholders. So the overall, let's just think about the overall value of the firm, or the overall value of the project, either the low risk project or the high risk project. So we're going to compute the expected value first of the low risk project. So that's just going to be simply, if we go back to our numbers here, we had 50% chance of a recession, which had $100 of cash. We had 50% chance of a boom, which had $200 of cash. So that's just that expected value of that low risk project is just the midpoint of those two possible values. So that's this 150 in expected value terms. That's 50% times 100 plus 50% times 200. The expected value in the case of the high risk project, we can compute that exactly the same way, except the returns are different. There's still a 50% chance of a recession, but the payoffs to a recession are $50. There's still 50% chance of a boom, but the payoffs to a boom in this case are 240. Again, we can just think of that expected value as being the midpoint between that 50 and the 240. And so the value, the expected net present value of that high risk project is going to be 145. So from the perspective of firm value, overall firm value, this high risk project actually would not be as preferred as the low risk project. If you remember from our capital budgeting lesson back in February, we talked about evaluating the flows of cash over time, and we would compute the net present value according to the discount rate and the timing of cash flows over time. We talked about how the higher net present value was something that was going to overall increase the total value of the firm. And so a net present value of 150 is better for the firm overall, better for the value of the firm overall than the high risk project. However, the tiered structure of payments to stockholders and bondholders are going to make a little bit of conflict actually between the stockholders and bondholders. So the expected return to stockholders, if we're just thinking about what the stockholders get under these two projects and under these two economic scenarios, the stockholders get $50. We have a possibility of getting 0 with a 50% probability, and a payoff of 100 with 50% probability. So the expected value of the low risk project to stockholders is $50. However, for the high risk project, if we remember what the returns to stockholders were there, this was the low risk project. We had the high risk project next, which had possible payoffs of either $0 or $140. Again, these two scenarios are each equally likely, so there's 50% chance of each one of these happening. Therefore, the expected payoffs to stockholders in the high risk project are just going to be the straight up average of 0 and 140. So that's going to be 70, right? So stockholders actually prefer a high risk project in this case because they get the residual claim. They get the residual claim on the firm's cash flows. They get to essentially capture the upside. This increase between the low risk project and the high risk project, basically that $20 increase represents the ability to capture the upside of the riskiness, right? Whereas the bondholders, they don't get to capture the upside of the riskiness, and in fact, they're actually hurt by the riskiness. They get paid in full completely. In the case that the firm takes on the low risk project, they get $100 in either economic scenario, but on average they only get 75 on average in the case of the high risk project because they have the potential to lose in the event of low cash flows. Okay, so that's kind of some setup for thinking about. Eventually, we're gonna use these concepts to think about what the effect of a merger is going to be, how two firms merging together, how that's going to affect the relative payoffs to stockholders versus bondholders, and how stockholders and bondholders might have different opinions about whether a merger is a good idea or not. Okay, so this is, keep in mind these two examples as we're taking this forward into this lesson 10 content. Okay, so one idea that we had presented, I presented this a little bit in that lesson 4 stuff, was thinking about the value of an option under different underlying fundamental conditions. This graph shows the value of the option, specifically the value of the call option at expiration, as a function of the price of the stock. So we're going to think of this as being an option, a call option on a stock. You've bought the right to purchase a stock for $100 at some future date. So that's what the exercise price is. We've gone over this a little bit in lesson 4, but we have the exercise price, which is the price that you're allowed to buy the stock at in the future. There's some expiration date. There's some time in the future at which point the option will expire, and then you can no longer exercise the option. But anytime between the present and that expiration date, you can buy this stock for $100, but you're not obligated to buy the stock for $100, or you don't have to actually exercise that option. So in the event that the stock price is above $100 at some future time period, you can purchase the stock at the $100 that was promised to you when you purchased that call option contract, and then you can buy it at 100 and then sell it into the market at the current market price, which could be something higher than $100. In which case, the value of that option to you is the stock price at that time, at that future time, minus $100. So if the stock price is 110 at some point in the future, you can buy the stock at the $100 that you were promised to be able to buy it at, and then sell it for 110 at the current market price, and you can net something like $10. So this, this value could be the value of the height of this line is something like $10 in the event that the future price is 110. Now, the fact that you're able to opt out and not actually exercise that option means that if the future stock price during the period of time between now and the expiration date is always less than $100, then you would, if you buy the stock at 100 and try to sell it at 90, you'd lose money, and so you just choose not to exercise the option, and your payoff in that case would just be given by the portion of this curve that's just on the x-axis. It's just zero for prices of the stock that are lower than $100. Okay, so that's kind of just a recap of how to think about the payoffs to options, specifically for call options. Eventually, we'll be able to see that the firm is essentially exactly analogous to a call option for stockholders. So the stockholders, essentially, as in the examples we've just seen, stockholders are able to capture upside in the scenarios when the firm is doing particularly well. They can capture the residual cash flows and benefit from that above and beyond what their debt obligations are. They get to benefit, but in the event that cash flows are particularly low, and if cash flows are low enough, the floor on their payoffs is actually zero. We saw that in the examples above here, where their floor on their payoff is zero. And in the case of a high risk project, they don't lose anything more than zero. In the case of a low risk project, they also don't lose anything more than zero. So that numerical example is hopefully helpful to see the analogy between the payoffs to stockholders and being the payoffs to the holders of some call option. Okay. There's also an alternative way to think about the firm as a put option. A put option is just going to be the exact inverse of a call option. So if I can blow this up again. In this case, if we think about a put option, let's say that you've purchased a put option with an exercise price of 50. A put option is the right to sell some asset at some fixed price. In this case, this would be the right to sell at $50. You've bought the right to sell a particular stock at $50 at some future time period. In the event that the actual stock is more than $50 in the future, it wouldn't you wouldn't get any payoff from buying a stock at higher than $50 price and selling it at 50. That would just lose you money, and so your payoff to that put option, the intrinsic value of that option is zero. You're not going to exercise that option. But in the event that the stock price drops below $50, and you're someone who holds this put option, it's if the price drops to 30, then you're able to capture some gain as a result of having that right to sell at $50, which you've agreed upon in advance. In that case, you can gain 20 by buying the stock at $30 and then selling it at 50, which your put option allows you to be able to do. So that's just it's a different form of an options contract. Basically, it's the right to sell some asset in the future, and it has a similar kind of payoff, except it's inverted, where you have upside under low values of the underlying stock, and then you have zero under high values of the underlying stock. Whereas in the case of the call option, you have the exact opposite of low values under or zero value under low values of the option, and then higher values when the underlying asset is more expensive. Okay, So let's bring this back. Bring this back to firms. So we're thinking about firms now as essentially options. Let's consider a firm that's going to have interest payments of $800. So these are the $800 of debt obligations. Those have to be paid back first before equity holders or stockholders can get any money back. We can think about, just again, simply two scenarios. We have, in this case, just thinking generally about what cash flows could possibly be. There's two possible outcomes. One is that cash flows exceed this $800 debt threshold level. In that event, equity holders still have to meet these, debt obligations, but they're going to get whatever residual cash is left over after they meet those obligations. So they get cash flow minus 800 in the event of this scenario, this top scenario of cash flow being greater than $800. And then in the other scenario, in the event that cash flows drop below this $800, equity holders get nothing. Okay, and if you think about that graph we just saw with the underlying stock price, I'll call that stock price V, the underlying value of the stock. The underlying value of the stock is on the x-axis. Returns to equity holders. That's on the y-axis. This graph actually has exactly the same structure as what we saw before, where this $800, these interest payments, now you can think about those as being like the exercise price. So you can think about this $800 being the exercise price. If the cash flow is less than $800, then equity holders get nothing. We saw that under those examples before. Cash flows at 50. Cash flows here being at 50, being less than $100, the equity holders get nothing. Cash flows being $100, again, the equity holders get nothing. That's irrespective of what the overall question in the chat. What if the firm? Is this a question in the chat? What if the firm does not have a dividend yield? Oh, you're saying what if they what if they're not paying out dividends that quarter? Is that or that over that time frame? Yeah, that's a good question. So what this is intended to capture is that. So let's think back to the cost of capital. Let's think back to the capital asset pricing model. If the firm is not paying out a dividend today, and if shareholders are okay with that, that means that the firm must be investing in something that is going to be generating a high enough future cash flow to make up for that not having that dividend today. So remember how in the capital asset pricing model we talked about how the stockholders would prefer the cash now unless the firm could invest that money in a project that would generate something above and beyond that. So the insight there is that either the stockholders will get the cash right now, in which case they'll be happy, or they're making sure that the firm, if it's reinvesting its money in projects, is going to invest in things that are going to be generating at least that amount of return in the future. So it's either they get the money now or they get some money in the future based on the cash flows of that project. So it's kind of thinking about the returns to equity holders. It might be cash now, but it might be cash down the line, which they are able to receive because the firm is reinvesting that money in the firm and generating a rate of return that's at least as good as having the money today, at least as good as the stockholders having the money today. Does that make sense? Does that answer the question? Okay, good. Yeah, that's a good question. So we're gonna just kind of assume here that the money is paid out, but even if the money's not directly paid out, it could be the case that they would be expecting to get more money in the future as a result of the investments that the firm makes along the line. So it's kind of a stylized example, but it captures the fact that there's going to be some expectation of returns to equity holders in the future. Okay, so that's all to say that this diagram will lead to the same sort of payments or a structure of returns to equity holders as that call option. And we're at time, so I'll get into this more on Monday. But as usual, I'll be around to stick to answer questions that there are, if there are any, on this stuff before we sign out. But I'll stop there for today, and we'll pick up with this on Monday.